remind yourself that equities is a long-term asset class. You need to be disciplined and stay invested, focus on fundamentals. I think this is as good a market as it can be.
While valuations are not cheap, we have to remember that globally government debt is at all-time high level, which is usually a precursor for very, very easy monetary policy, because when the biggest borrower is setting the interest rate, there is incentive to keep the interest rates very low versus inflation.
I think earnings estimates for next 2 years on a CAGR basis would be clearly in mid-single digits. There would be some cuts, but still we're looking at healthy returns from this asset class.
Policy support has been tremendous. Fiscal policy support and monetary policy support. I mean, the RBI has come out with aggression which we haven't seen for a long time. That sets the groundwork for a strong recovery in the next financial year. We have already got, I mean, the current estimates are very healthy.
Hello, everyone. We are meeting at a time when things are looking a little better for the equity markets. The benchmark indices, Sensex and Nifty, are closer to their all-time highs. Foreign portfolio investors are net buyers again after being net sellers in the preceding 3 months. And there is a lack of disappointment, if I can use the term, as far as the September quarter results are concerned. But things have been anything but rosy for equity market investors over the last 12 months. In many ways, the condition of equity market investors was similar to the protagonists of the film One Battle After Another. I'm sure some of us must have seen it. It was, if last 12 months were to be made into a film, I would call it one Truth Social post after another. And we were constantly in a state of shock and anxiety, and we were constantly looking for a way to reach a position of safety for better returns. If, in that film, Leonardo DiCaprio's character, he is constantly in search of a secret code, which he can't remember. He's in trouble, and he needs to remember a secret code to reach a position of safety. And the condition of investors, equity investors, is very much similar. So we were in the last 12 months, frantically searching for that secret code. And earlier wars and central bank decisions and big policy disruptions used to rattle markets. We just need one Truth Social post to rattle us now. So we have these 4 gentlemen who between them hold the keys for that secret code for better returns, and we are trying to we are trying to understand a way for better returns. Jokes apart, we are trying to understand where are the opportunities as far as equity investing is concerned, and how things pan out in general. So to begin with you, Mr. Gubbi, so Sensex and Nifty has yielded single-digit returns. The broader mid-cap 100 has also given single-digit returns. The Nifty small-cap 100 is down 1.6% on a YTD basis. So, but valuations remain above their long-term averages over their 10-year forward. When you compare it, is above. It's more steeper in the case of mid and small-cap indices. So, what is your assessment when you look at the market conditions? I want all of you to give your initial comments on this. Does it inspire confidence? Does it make you skeptical? Mr. Gubbi first.
Yeah, I think after pretty much the post-COVID 5-year period, we had 4 years of exuberance, and 1 year of return to some sort of normalcy. Like you said, even now valuations are pretty much above their historical average. Between caution and optimism, I think it's a cliche term to be cautiously optimistic. As equity investors, we need to be optimistic, but at the same time, the core of what we do is risk management. To that extent, there has to be a sense of caution as well. I reckon the point in time that we are in the markets defines that perfectly. There are no obvious themes to play. You talked about single-digit returns. Why not? The earnings growth also has been in single digits. But at the same time, valuations somewhat have time corrected, but still not at a level where you can say screaming buys. That makes our job easier in some sense, or our jobs relevant because we are at a stage where stock becomes more important. It's a pretty much a bottom-up market. The easy money that was there between 2020 and 2024 is over. To that extent, if you remind yourself that equities is a long-term asset class, you need to be disciplined and stay invested, focus on fundamentals. I think this is as good a market as it can be.
Okay. Mr. Gundwani, your comments?
See, I don't think PE or price to book is actually a good way to look at the market. I think over the long term, if you see, equities tend to return about 5 to 7% above inflation. And if you take a 10-year or 20-year period, we are somewhere around 6.5%, 7%. So we are perfectly in the fair value zone. I don't think we need to be very greedy. I don't think we need to be very fearful. Having said that, I do think that while valuations are not cheap, we have to remember that globally government debt is at all-time high level, which is usually a precursor for very, very easy monetary policy, because when the biggest borrower is setting the interest rate, there is incentive to keep the interest rates very low versus inflation. So we've seen it in Japan, for example, which has been running negative real rates for a long period of time. So I'm actually not very defensive about equities. I think on a 3-5 year basis, double-digit returns are my base case for returns.
Okay, Mr. Mistra, your thoughts is caution the better part of valor, or,
No, I mean, I have a constructive outlook. Of course, it depends on the horizon we're talking about, but for investors who are looking at the markets with a 9-month, 1 year and beyond sort of horizon, I have a very constructive outlook. First, of course, is the health of the market is very robust. It's a diverse market. There are, buyers, but there are also a large amount of sellers in recent times. We know the FIs. So it's a diversified market. It's not a one-sided market. Of course, within that, there'll be sectors, but on an aggregate. Then additionally, the markets have not given returns in the last 1 year, but it's because there were excesses earlier. And when you think of it in the recent 1 year, for instance, the markets around the world, whether it's leaving aside US, but if you think of, the other emerging markets, Europe or Japan, all of them have had returns clearly superior to India, but it's been driven more by re-rating. So for a change, India has had just a little bit of returns and mostly led by whatever earnings growth has come by. But the reason I'm really more constructive going forward is these cycles I'm seeing, sort of the growth outlook, which should be getting better. We've had enough policy measures put in place, whether it is direct tax, indirect taxes. And therefore, on the back of that, I would think, whether it's the credit cycle, even the automobile, it's a big part of the manufacturing, so that cycle should kind of restart. Real estate, as long as the builders don't get too greedy with price increases, should also be on a slightly continued upward tick, I would say. So yeah, we've got some big parts of the economy which should be looking up, and therefore the earnings growth, while we've had a bit of a lean patch last 2 quarters, but should start getting better as we progress into the quarters ahead. I think earnings estimates for next 2 years on a CAGR basis would be clearly in mid-single digits. There would be some cuts, but still we're looking at healthy returns from this asset class over others. And valuations, where we are right now as a starting point, are around average at an aggregate. Of course, so therefore, it's going to be more about stock selection at the bottom of bases and all that. That will matter.
Mr. Shyam Sundar.
I echo a lot of what has already been said, but to set the context on why we have underperformed in the last year, first, the context is that there is a global equity bull market happening right now, and we have not participated. The reason for that, of course, we've done well last year, but our earnings disappointed very materially in the last year. What we're seeing in recent times is that maybe that extent of disappointment is reducing, and the catalysts are in place for an economic recovery. The policy support has been tremendous. Fiscal policy support and monetary policy support. The RBI has come out with aggression which we haven't seen for a long time. That sets the groundwork for a strong recovery in the next financial year. We have already got, the current estimates are very healthy. Unlike, normally they get cut a bit going into the year, but even if it doesn't get cut to the extent that, we've happened this year, we're setting ourselves up for a good next year.
I want Mr. Gopi and Mr. Gunwani to your take on earnings, and after that we will come to, we also had this last 1 year or so, we had a number of measures to boost consumption and to make, the impact of tariffs, etc., bearable. Like we had the income tax exemptions being raised, the GST rationalization, and as Mr. Shamsundar said, RBI has been cutting rates. So how is this going to sort of play out in the markets? How is it going to trickle down at the ground level? First, your take on earnings, and then about these measures. Mr. Gopi.
Yeah, so earnings, I think we're pretty much at the bottom of the earnings downgrade cycle. If you saw the last 2 years, pretty much 6 to 7 quarters, consistently analyst expectations have been missed, and we've seen the downgrades. This is perhaps the first quarter where we'll see fewer downgrades coming through. I'm not saying the earnings growth has recovered dramatically, more like expectations have come down. Now we are pretty much looking at FY27, possibly a mid-teen sort of an earnings growth. To that extent, I think we are in a sensible position, because at the end of the day, markets work on expectations. As though disappointments which led to the modest returns that we've seen in the last year, if expectations have been beaten down, I think we need to be a lot more positive in terms of the markets. As far as the effect of GST and consumption, I think on the ground feedback is pretty good across consumer durables, auto. I think the consumer has responded positively to these cuts. As it is, I reckon the consumer was bottoming out in terms of the cycle. Given the excesses post lockdown opening up, we saw boom in retail borrowing and then eventual clampdown by the RBI. The consumer went through 4 to 6 quarters of tightening purse strings and repayment of debt, lowering of EMIs. We reckon we are at a stage where these cuts, both the income tax cuts as well as the GST cuts, plus the fact that the consumer balance sheet is relatively better compared to, say, a year ago, should result in both economic recovery through consumption, which is a large part of the GDP, as well as top-line growth for many companies exposed to these drivers.
Mr. Gunwani, your thoughts?
Actually, I'm not very bullish on large cap earnings. My sense is that if you take long cycles, there are periods where corporate earnings of Nifty 100 outperform nominal GDP, and there are cycles where it underperforms. So if you see 2002 to 2011, 9-year cycle, corporate earnings of Nifty 100, they grew very fast versus nominal GDP. Then for 9 years, 2011 to 20, they grew much less than nominal GDP. Now the thing is, 2020 to 25, you've had 5 years where Nifty 100 earnings has grown at 20% CAGR roughly versus nominal GDP of 11%. Now, when you're sitting on such a high base of 5 years of earnings outperforming nominal GDP, I think the best you can hope next 3-year CAGR will be nominal GDP, which will be 10-11% for Nifty 100. But I think this market is actually, personally, I feel, a small cap market actually, because there is so much technology change, there is so much of geopolitical change. The real growth is going to be beyond Nifty 100 or Nifty 200 also actually. So I do think that if you want companies which can grow at 20-30% CAGR for next 5-10 years, I don't see very much in the top 100-200 companies which can deliver that.
That's interesting. Mr. Mishra, your thoughts, do you agree with Mr. Gunwani's assessment that, we have to look beyond the top 200 companies to spot the real winners? And also both you and Mr. Shamsundar, about how all these reform measures, when will it trickle down and how is it going to play out in the equity markets?
Okay, so first, in terms of the reform measures, I think we have seen some signs clearly on the discretionary part, the automobiles, etc. But surely, when you add up the tax breaks, both direct and indirect, there will be more disposable income. There are differing elasticities of demand. So, some of these segments have seen that already play through, but net, because there will be more disposable income, depending on the propensity of, but there'll be demand for even, at the extreme end, staples, select categories where maybe penetrations aren't, still there in the country. And then, upwards to maybe residential EMIs will become more affordable as rates are also coming down, maybe into savings. So it's going to be a blend spread across, the whole spectrum. And therefore, we have to monitor and watch how it's panning out. Initial signs, at least in a few categories, are known. So I'm kind of comfortable with that playing out and looking forward to that. Then we know that next year there'll be the pay commission also, which will help. To the question on what categories will do well, see, I mean, India, where we are, a $4 trillion economy, it's a given. This year, no doubt, inflation's been very low, so we're looking at a sub-optimal, a sub 10% nominal growth. I think as the base sets in next year, calendar year, we should be back to that, 10% plus nominal growth. And, with that kind of growth and a GDP, which is where it is, I think it's going to be the whole corporate sector which will participate, because you've got the big entities, whether they're the automobiles or banks, they can't be left behind if India is going to become a $5 trillion and a $7 trillion economy. So the trick would be to capture, good companies which are going to, partake of this opportunity in a profitable manner. And of course, you want to get them at the best valuation. So I think opportunities will be there across the market cap curve. Having said that, the composition of the market caps also vary, right? The large caps have a certain dominance of, say, the larger IT or metals, or even the banks, maybe staples. So not all of them are going to be equally attractive, but and vice versa. The small cap, mid caps will have their share of maybe more hospitals, more chemical companies, more engineering companies. So you got to be present across, because my belief is that the India opportunity is a structural one, it's a decadal one, and it's going to be spread across cohorts, across market caps, across industries. So it's just that nature of the indices are such that you have the compositions vary. We have new IPOs, some come into the mid, some are coming into the large and small as well. So, and there'll be winners across. So I think it's going to be a very, very promising sort of market across the market cap. So then the question is how to participate. That's more an allocation issue between how do you want to do it between these various market cap cohorts.
Since you mentioned valuations may not be at a desirable level all the time, so how does one take a call, like when valuations are not that great, or it looks, slightly elevated, but the company looks promising? So how does an ordinary investor take a call or whether to buy that stock or not?
No, I mean, if valuations are not comfortable, or they seem to build in all what is the growth, valuations also got to incorporate the quality of that business, the character of that business, your comfort with that character being resilient, under all periods of stress and so on, and also the growth. That's a function of the opportunity that business is addressing, the TAM and all of that. But if all of that is still suggesting that there's too much of growth built in, the price is building in growth which just can't be reached, done on a year-on-year basis, then it's best to stay away, of course. But it's a good market because you have a lot of sectors, right, across, and companies within sectors. So you have to pick. You can't. You have to pick and choose. And I'll just add one thing. I think as we speak now, clearly, as was being mentioned, that the earnings growth outlook for mid caps may be better, slightly lesser for the small and the large caps. But yeah, then you got to incorporate valuations in.
Yeah, since you mentioned mid caps, even their valuations. I'm talking about the mid cap 100. It's it's slightly above the 10-year averages. The Nifty is little 1% or something, but the mid cap 100 and small cap 100, it's a bit more elevated. So how does one play the mid and small cap space? When we are confronted with this dilemma, when the valuations are looking steep, but maybe the company is looking promising. So how does one play that?
See, I mean, it's a function of the comfort one has, first of all, with the business. Okay, and I'll just add one caveat here. Small caps tend to have greater fatality historically. There'll be more dropouts from the small cap for whatever inherent weaknesses, which would be more, management, lack of management bandwidth and all of that. Typically the small caps. With the mid caps, that's not the case. So that's a good fertile hunting ground. So as far as, the valuations, Yes, at an aggregate, they may be higher right now for, say, some of these indices, but it's really a bottom-up, effort where you've got to incorporate other attributes you want in that, in that business. And for a retail investor, either you're tracking it closely and you're comfortable with management attributes and, that business, else you want to, give it to professionals who are doing a, job of it day in, day out. And in any case, keep allocations kind of done nicely, and you have to review them so that you're not, especially if some part of the market is done very well. So you want to, at some stage, as valuations have gone to an extreme, then reduce your exposure there. Your weights to that sector, say small cap, might have gone above what is an optimal desired threshold. Then you'd want to reduce it down, right? So yeah, it's an ongoing thing. You, as a retail investor, if you're doing it yourself, then you have to really dirty your hands, be completely involved in tracking it. But if you have left it to a professional, even then you should review your allocations, periodically, maybe 6 months, a year, and then take it.
Yeah, Mr. Shamsundar, I also want to ask you, since you mentioned themes and all, we had this thing called the momentum stocks, when something will run up and everybody will chase, and those who start at the fag end burn their fingers. So how does one sort of insulate oneself from the market chatter? And also, since valuation is being mentioned in social media now, there is a lot of noise about valuation of one particular stock, one IPO. So how does one keep oneself independent-minded, if I can put the word, in, when there is a lot of noise all around?
Valuations is a separate, it's a full topic itself. There are books which are written on it, so it's a bit hard to capture that in a 15-minute discussion.
I'm just asking you for, ordinary investors like me.
Sure.
So, for the ordinary folks. So how does one take a call?
So, momentum, FOMO, all of those are real effects which play out for not just retail investors, but even professional investors continuously have to fight it. So, for us at least, it's about anchoring ourselves into growth expectations. See, valuations, in the end, if I had to simplify it, 3 parameters matter: growth, return on equity, and cost of equity. Those are the 3 things you can create a full valuation framework using these 3 parameters. Now, the assessment which becomes difficult to do is to estimate how much the sustainable return on equity will be, or return on capital is going to be, or how sustainable is the growth? What is the longevity of the growth? What is the growth pipeline? What is the management's ability to tap into adjacencies and unlock growth rather than just the current line of growth? So it is a very challenging art. It requires a lot of deep work, and I don't think there are any real shortcuts which can be used, because nowadays many of the IPOs, without getting into names, are not profit-making. So and they're not necessarily stable businesses. They are coming at a point where there is substantial growth which is still being unlocked. For example, the food delivery companies. They moved into adjacencies and they have unlocked a new paradigm of growth for them. So these are not stable businesses, and their returns as well as sustainable cash flows and growth potential are not stable. And so it is a very challenging art to do. So no easy answers, but just giving a flavor of what the complexities in it are.